we are in an uncertain environment, right? We don't know what's going to happen tomorrow. So how does one prepare for these uncertain times?
Even as investors, I think even as institutional investors, there is no one standard way of dealing with uncertainty, right? There are multiple ways. I mean, even if you look at portfolio managers working with the same product like a multi-asset, for instance, you might find different ways that people will deal with. Someone might choose.
Today, when we are seeing this, we are elevated crude oil prices, right? What roadblocks do you see with this high crude oil prices which we are seeing as of today?
It's a very challenging environment, no doubt. Historically, energy prices have always been a very big determinant, I would say, of.
So, would it be fair to say that a balance advantage fund is a good entry point for a first-time investor?
It's a good way to enter for a new market participant, but not necessarily. I wouldn't.
Hello and welcome to Ventura Spotlight, where we bring you conversations with experts shaping the way India invests. In this episode, we are pleased to have with us Srinivasan Ramamurthy, Senior Fund Manager, Equities at HDFC Mutual Fund. Srinivasan has over 15 years of experience across equity research and fund management. He is an engineer from Jadavpur University and is also an alumni of IIM Kolkata. At HDFC, he manages the equity allocation across a range of equity and hybrid strategies, including balance advantage, multi-asset allocation, equity savings, hybrid debt and equity, and many more, with an AUM of over 1,60,000 crores. So let's get started. Hello, Srinivasan, and thank you for taking time out to be on this Ventura Spotlight with us on this podcast.
Sure, glad to be here, and look forward to the interaction.
So, Srini, before we start off, I would like to understand that, since you have got quite a lot of experience in the equity markets now, so what made you, you have an engineering background and also a management graduation from IIM. So what made you, attracted towards the equity markets?
Okay. So unlike a lot of people in the markets, I incidentally had almost no, I would say, exposure to markets in my growing up years. I mean, in my family, in my friends, there was absolutely, markets was not something which was anywhere visible in my life till almost probably till I was in college. But I think, I to a very large extent, I think I got familiarized with this field, or got to know about, or got awareness about this field during my management and engineering also to some extent, more towards once I entered management. I think one thing that I've always been a little bit inclined towards is academics, and I've been a little bit more academically oriented throughout. And there is there is a bit of an overlap, I would say, in this field, a little bit more overlap in this field to academics than to some of the other fields. So that probably was one of the key reasons why I kind of, post my MBA, it seemed a natural fit to kind of get into markets. And of course, once you entered markets, then it has its own way to kind of keep you engaged, and there are a lot more other aspects of it which become apparent as you move along in the field.
So, one more thing is that since you are managing more in terms of the asset allocation part of the piece within the fund space, and I think it's becoming very, very relevant and very important part of a discussion nowadays, and we are seeing a lot of traction happening.
Right.
We have a lot of optimism and fear currently in the markets, and so how do you see asset allocation versus stock picking? I mean, how different is it, and how do you go about doing this activity so very well in your funds?
No, see, I think asset allocation, in general, is of course, has always been a very important, I think, aspect about of markets. It of course gains a lot of prominence, and it gains a lot of, I would say, mind share during times when rotation between asset classes become very apparent. And I think in this, obviously, in this post-COVID world, we have seen a lot of changes in that aspect, and which is why I think it has got the amount of attention it has got in the recent past. But to my mind, I think the key difference between asset allocation and if I'm just kind of looking at as an equity fund manager, if I'm just looking at stock selection, I think the key difference is one, I think it is a lot more, I would say, top down. Asset allocation calls are, relatively speaking, are a lot more macro, a lot more top down heavy. You can't kind of aggregate from a very bottom up basis. There are very few things that you can do. The other aspect is that in asset allocation calls, because you're dealing with asset classes as a whole, you can be a little bit more scientific about it. In stock selection, I think the softer aspects, the quality, I think there is, like they say, science art. I think there's a fair bit of art to kind of ascertaining which companies you want to invest in. But here, I think you can be a little bit more scientific, and frameworks kind of help you a little bit more take these calls. So I think that would be the broad way I would think about these two being different. And because there are so many more variables, I think it makes it that much more challenging as well to kind of catch the right cycle for the different asset classes.
So now we have a lot of different types of strategies which are being followed by many fund houses. The investors have their own thought processes towards asset allocation. So if somebody and if you have to look at it yourself from your perspective, one is from the fund. Obviously, the fund has got a mandate, so it has to be within that mandate. And but if you had to even look at it from a investor perspective, if you look at it from yourself, how would you go about doing an asset allocation for yourself? Right now, I will come to the actual the multi-asset allocation and why that's a good product. I will actually come to that. But if you have to look at it, independently, and we predominantly have three main products, which is equity, debt, and precious metals. Gold and silver. Some of them they do. So if you had to allocate for yourself, how would you go about doing that? And what are the factors you would keep in mind while doing a shift between equity and debt and gold?
Okay. See, I think to a large extent, of course, you're asking as an individual investor and not as an institutional investor. I think there's obviously a big difference between the way you would approach
Correct.
These two. I think to a large extent, from an individual investor standpoint, I would be thinking about this more in terms of just a diversification tool. I would not be too bothered about being very scientific about at what points in time, whether I'm kind of riding the right cycle, whether I'm kind of getting into an asset class with the right, having seen backtested things and things like that. To my mind, I would just think about, if this is my overall financial corpus that I need to invest, am I adequately diversified? That's the only way I would think about putting my own capital to work. And of course, there are nuances to that as well in terms of how you would want to approach that exercise. Some people can be a lot more scientific. Some can be broadly. To my mind, as long as the person is aware that he needs to be a little bit diversified, particularly when he is dealing with investments which are not very long horizon investments, right? There are certain long horizon investments where you can be tilted towards a certain asset class. So for instance, if you're really thinking about investing for retirement, or you're thinking about investing for, in many cases for generational wealth creation, there is no problem in being in equities completely. For that corpus, you don't need to really think about asset allocation, because that's a corpus which you know that if the journey is tumultuous, you're still okay with that corpus. But for short to medium term kind of requirements, I think I would be thinking in terms of being adequately diversified so that I'm not prone to the timing risk that normally comes with asset classes going through bad phases.
So now I come to the the fund side. From an investor perspective, I mean, you gave a reply. Right?
Yeah.
Now, I mean, post how the taxation is working, right? So,
Yeah.
multi-asset as a product. I mean, we have seen a lot of changes in the taxation structure. That
Yes.
now, if I am in debt, if I invest in debt today, I have to pay tax at the full rate.
Yeah.
If I am in gold, maybe I have to hold for 2 years.
Yeah.
Equity is 1 year, and for every if I keep on shuffling my assets, I need to keep on paying capital gains tax, right?
Yeah.
Which was not the case maybe prior to 2018 when long-term capital gains stocks tax got reintroduced.
Yeah.
Right? So from that perspective, I think multi-asset asset allocation funds actually fit in very perfectly because the mutual fund has a benefit of not paying any tax when they are doing the transactions internally
Yes.
within
That's
the
right.
fund, right? So
That's right.
you can follow a disciplined approach. There's no taxation implication. So when you look at it from a fund angle, since you don't have that constraints, that if I sell equity now, I'll have to pay long-term capital gains tax. So I will not do any transaction just now. That happens at the individual level.
Yeah.
So from a fund perspective, how is it that you go about doing this strategy? And
Yes.
obviously within the mandate which
Of
you
course.
have.
Of
Right?
course. Yes. Correct. So yeah, I think what you, as you rightly said, I think it's I mean, these are products now which have become extremely efficient in terms of, I mean, from a tax adjusted basis, the ability for these products to kind of do a lot more than what you can do as an individual is clearly there. And which is why I think, I mean, even the regulator has kind of introduced and kind of bucketed different strategies in different kind of products and categorized them very clearly so that the end investor is very clear about what outcomes they can expect from each of these kind of subcategory of products that you are choosing. So in a multi-asset kind of an product, I think at least in the Indian context, I mean the way that we have currently this product is positioned, I think it's a product like you rightly mentioned. It has only three major asset classes. I mean it has equities, it has debt, and it has commodities. Obviously in the global context, it has a lot more.
Correct.
I mean you will have emerging market equities, developed market equities, emerging debt, global debt, absolute return products, private equity, venture kind of products. So there, the diversification is much higher. In the Indian context, it's a little bit more curtailed at this point in time, but I'm sure over time, I mean, we will make that transition as well. But to your point, I think the way that we work in kind of running these products, I think the thought process is to make it as framework driven as possible. I mean, you want it, of course, for making the frameworks, creating the frameworks, you need to apply your mind. And no frameworks are cast in stone. You have to kind of keep reevaluating as things do change and your thought process keeps getting improved with every market cycle, and you do keep that feedback loop open. But having said that, once you have a framework in place, it makes life a lot more easier because it brings in the discipline that you have to do, and you don't get into that mindset of chasing momentum or continuing with something which is working well for you, which is typically where I think as investors without framework, I think that is where those are the areas where you can get pushed back because you may commit mistakes of timing. And as far as the frameworks themselves are concerned, I think to a very large extent, the frameworks try to ascertain the attractiveness of different asset classes at different point in time. And that's what we try and do. This can be through different vectors. Of course, valuations becomes a very important vector in understanding which asset class is attractive. In addition to valuations, you also look at least from a timing standpoint, sentiment becomes very important. You do try and gauge where the market sentiments are at extremes, and typically the best timings work when you do see excessive pessimism or optimism into a certain asset class, that's where it's best to kind of take a contrarian kind of a positioning. So sentiments do matter, and of course your macro cycles also matter. So these are, I would say, 2-3 key vectors. Liquidity. I mean, these are, I think, 3-4 top vectors which I think one would keep in mind. Valuations being the primary vector, but these 3-4 other vectors help judge between the asset classes which one is looking the best at any point in time, and accordingly, within, like you said, within the mandate, you try and allocate to these asset classes accordingly.
So, when we also see a lot of multi-asset funds, and today it is very difficult to compare one multi-asset with another multi-asset because each one has a different strategy, each one has a different equity allocation. Right? So some have more than 65, some have less than 65. So it becomes very difficult to it would be comparing an apple to an orange in a way, right? So even they come under the broader ambit of the multi-asset allocation funds, right?
Correct.
So what would be a matrix an individual investor can use to try to that how does he determine, because most investors look at the returns.
Sure.
If equity market is doing well, all equity multi-asset funds will be showing fantastic results.
Yeah. Correct.
And when equity is not doing well, they'll be at the bottom.
Sure.
Right? So how any particular matrix you would recommend for the investors?
See, I think to a large extent, I mean, it's a very critical point that you did bring up. I think it's a very important aspect of, and this is more true for this as a category. I mean, because this is a unique category where the benchmarks are not uniform. I mean, this is probably the only category where I think the benchmarks are allowed to be ascertained by the fund house. Whereas in every other category, the benchmark is given, and hence to that extent, we are all working with the same benchmark. I mean, when I look at my other products in the hybrid category itself. So here, I think there are two ways to kind of judge performance. One is keeping in mind the respective benchmark of each of the product. How are they faring versus their benchmark? Because in general, over long cycles, it is most likely that the benchmarks will converge. I mean, it is unlikely that there will be periods in time when commodities will do very well, and commodity heavy benchmarks will of course do much better than non-commodity heavy benchmarks, which has been the case for the past maybe 1.5-2 years. Similarly, there will be phases when equity as a benchmark, which is equity heavy benchmarks, will do much better than the benchmarks which are more aligned towards commodities. So I think one is to ascertain any fund with respect to its own benchmark, because in these kind of products, the benchmark itself is really very good. I mean, the benchmark over long periods of time gives you that stability and the low volatility that you would want from a multi-asset kind of a product, because the benchmark is diversified. So as long as the product is doing well versus its own benchmark, I think that's a good starting point. The second way to kind of judge many of these products is to, of course, look at risk-adjusted parameters. So the idea of these products is not to get the highest return. The idea of these products is, it's less about the journey. Less about the destination, more about the journey.
Correct.
So are they kind of being less volatile while you are taking you towards your destination? So to that extent, any risk-adjusted parameter like a Sharpe ratio or any of those parameters would be the second way to kind of think about whether the products are delivering good outcomes from. I think that's, from an investor standpoint, I think these are the two broad vectors on which I would judge multi-asset products today, versus their own benchmark and versus a risk-adjusted parameter like any of the ratios which gives you a risk-adjusted outcome.
Yeah, because I think multi-asset is actually supposed to be less volatile compared to
that's right.
A pure equity fund, or whether even a balanced advantage fund or whatever.
Correct.
It should be less volatile than that.
That's right.
Okay,
fair. So you should look at standard deviations. You should look at Sharpe ratios, information ratios.
So I think looking at ratios over here is much more relevant than just purely looking at the return.
Absolutely.
Okay.
That's critical to ascertaining whether the outcomes are in line with what you had invested in it in the first place. You didn't invest it for returns.
Correct.
That's not the category mantra, so to speak.
Right. So I think that's a very important point, and thanks for that. So I think because what we look at it is that today it is most investors always will have equity in their portfolio. They will be having debt in some form. It could be a bank FD, or it could be a debt fund. They have gold as a part of the portfolio. Now,
Yes.
apart from whatever they want, I think what a multi-asset actually brings across for them is a more of a disciplined approach, because
Yes.
and a more tax efficient manner today,
Yes.
in terms of because the debt is also a part of the equity, and
Correct.
his taxation becomes 12.5%.
Correct.
So it becomes a little more tax efficient, so he can get a better post tax return when he looks at his entire asset allocation as a portfolio put together itself also.
Correct.
I think
Correct.
so obviously that means but the ratios are very important that he needs to look at.
Yes.
Okay.
Yes.
Right. And now when you look at the equity allocation as a part of your portfolio, so what sort of broad triggers that you look at, in terms of one is, okay, obviously when the market suddenly starts going down, and that becomes one trigger. But apart from that, do you look at any other factors in terms of that, okay, now we need to increase the equity allocation, now we need to decrease the equity allocation?
Yeah, I think broadly, like I mentioned, for every asset class, and it's true for equities as well, I think the attractiveness is judged on those 3, 4 broad vectors that I mentioned. And valuations is, of course, a very critical vector there. So, whenever we build these frameworks, there is a very big weightage given to valuations. And within valuations, of course, there are various ways in which you can value equity as an asset class. I mean, we can look at many parameters, so to speak. So then you try and backtest that which parameters are kind of giving you better outcomes, particularly in a certain market context. What the parameters that might work in a US market may not necessarily hold true in Indian market. Some other parameter might be more useful to kind of judge it. So that's the second thing to do, which is once you have said that valuations are important, then you choose through backtesting which parameters are better serving your purpose for the task at hand. Then the second vector that I spoke about, sentiments, that's extremely important. I think sentiments in case of asset classes, in the absence of, like I said, I mean, this is the art, so to speak, in the context of asset classes. Here you're not judging management. You can't sit right in next to the management and talk to them and judge what is their
Correct.
body language, how do they come across. So here, market as a crowd gives you that flavor. I mean, market is at the end of the day accumulation of a large number of people acting. And so when many participants starts to think alike and start to act alike, sentiment excesses do get created. And those are important trigger points for us. I mean, particularly in the style of investing that I'm talking about, which is contrarian investing. I mean, a lot of what we do, I mean, in terms of asset allocation work is very, to a large extent, when we say attractive asset class, we are saying that it has to be contrarian to, and then generally the best time for investing in asset classes come when you are a little bit contrarian to what the market philosophy at that point in time is. And sentiment excesses gives you those points. I mean, some asset class could have done well, but it has to do exceptionally well, or it has to do well to a certain extent for you to say that now sentiments have become excessive, for you to start booking profits or reducing, and then going maybe even zero in a certain asset class. I think those are things, I mean, for you to take extreme action, the sentiments have to be giving you extreme signals. So that's the second vector, I would think. The third aspect, like I talked about, is macro cycles are also very important. When you're dealing with asset classes, I think a large number of macro variables matter. So keeping a track of all those macro variables gives you some sense of where you are in the macro cycle, and accordingly you can adjust your allocation accordingly.
Okay, thanks. Now, when we see investors, most of the investors spend a lot of time in trying to figure out which products to invest in. But none of them will try to focus more on that. What is the type of asset allocation they want? So either they are like full in equity. I mean, I've hardly seen anybody doing a very, very scientific asset allocation at the individual level. So what would you suggest to investors that how they should go about doing the journey, because uh, people don't follow asset allocation, they just chase returns. So if gold is doing well, everybody is going to gold. If interest rates are high, everybody goes towards that,
Right.
right? And if equity is doing well, everybody is going towards equity. So what would you recommend to investors, in terms of asset allocation, how they should look about going about it?
Right. No, there is no, sure. I think your point is taken. I think there is a fair bit of truth to what you said, but equally, I would argue that that we have traveled some journey there in terms of, I think, if you look at where we were as individual investors probably 10 years back in the country versus where we are today, I think there is a lot more money coming through the route of financial advisors, and I mean, where people like you play an important role. I think there are a lot of people who are not doing this exercise in siloed manner today. There is a lot more of active handholding being done by financial advisors to kind of say that these are the products basis what you are looking at from your goal standpoint. These are the products that you should be investing into, and hence to that extent, this is the asset allocation that you should be pursuing. So there has become a fair bit of, I would say, progress on that count. Of course, I mean, have we reached the ideal situation? Not yet. I mean, there is still some journey to be covered, but I think we are on the right track in terms of the journey per se. The second thing is, of course, one can be, a lot more scientific even as financial advisors. But there are financial advisors who are very scientific. There are some who are in that journey themselves to become more scientific about what they recommend to their end clients. So to that extent, I think as end investors, one thing is, of course, to kind of rely, or if you have the capability, you read up yourself and kind of understand the diversification and how contrarian investing works. If not, then you trust some of the financial advisors and kind of go with them. The only place where I think as an individual investor where asset allocation is still probably still very skewed is the overall net worth. Within the financial net worth, I think the progress has been fairly decent. But even if you look at somebody's portfolio today and in terms of his overall net worth, it might still have a very high skew in India, for instance, in real estate or gold or, that skew or their business. So that skew is still there. But within financial capital, I think we have made good progress in terms of asset allocation being given some importance in that.
I think real estate actually skews the entire dynamics of your asset allocation.
For a lot of individuals, I would suspect that would skew very meaningfully.
Very rightfully said.
Yeah.
You also have a role to play in the balance advantage fund, and now with more than 1 lakh crore plus in the balance advantage fund now, do you see size as any problem in terms of managing the asset allocation, or do you feel that that it doesn't matter because the Indian market cap itself has also grown quite sizably, and it doesn't matter? What are your thoughts on in terms of the size of the fund?
No, right. I think what you said is correct. I think it's of course a reasonably sized product, but at the same time, in the context of overall market, it is still not very big for you to kind of say that it's becoming a big challenge. But having said that, I think it's both a benefit and there is a flip side to being a big sized product. One is, of course, from the context of if I think of is the constraint that we work with. I think the biggest constraint would, of course, be the liquidity aspect. When you have to change allocations in a very quick time, if you have to change allocations very meaningfully, it becomes, to that extent, it becomes imperative that you are slightly speaking, to a large extent, you have to become slightly more large cap oriented. I mean, as a product, you can't run a very mid and small heavy kind of a portfolio, because all said and done, there will be times in the market where mid and small will not have adequate liquidity for you to make that shift. So that's one aspect, which is a bit of a constraint, where in this kind of a product, it has to be, I would say it could be a large cap oriented flexi cap kind of an approach. The second thing about this is, of course, the other way to kind of mitigate this risk is the way we also do it in many instances is because the futures market in India is fairly liquid. So you can do a fair bit of asset allocation changes, at least in the very short term, through the futures market. If you want to kind of increase or reduce exposure, the F&O market allows you, particularly at the index level, you can do some bit of support you get from doing those kind of, particularly when the journey has to be very quick and quickly undertaken. At the same time, there is a benefit of having the size, which is that it forces you to think medium to long term. You don't think short term. I mean, if you're very very small in size, you might think that you're nimble and you might want to kind of play every tactical move in the marketplace. However, because you are big in size, you understand that what you're playing for is reasonably big changes in the market structure, reasonably big cycles. So your frameworks also adapt to that. Your frameworks also ensure that you only make changes which are meaningful from a medium to long term kind of a standpoint.
Okay.
And that tends to add value to your overall investment process.
So would it be fair to say that, a balance advantage fund is a good entry point for a first time investor, a younger guy who's trying to enter the investment time horizon? So would it be fair to say that?
Yeah, I mean, it's a good way to enter for a new market participant, but not necessarily, I wouldn't characterize a younger guy as a right audience.
Okay.
For a younger guy, I would imagine he should be into equities fully.
Agree? Yeah.
I mean, he has a long time horizon. Ideally, he need not necessarily be in a BAF kind of a product. For him, he's in a wealth accumulation phase, so he can be a little bit more aggressive on the front foot. But yes, I mean, in the sense that if someone wants to get a flavor of the market without getting exposed to big drawdowns, which can kind of unnerve them. To that extent, I think for those set of people where behavioral issues can be a roadblock,
Correct.
I think BAF is a good product.
Yeah. No, the reason why I asked you is that we have seen a reasonably good rally in the. I'm talking of 2 years back, where small cap was a flavor.
Yeah.
Right. And everybody got into the small cap, and and then the behavioral pattern comes into play, and then they realize that it is not as hunky dory as it sounds, right?
Yeah.
So to have at least a smoother journey.
Yes.
One can say that BAP is at least a more smoother, less volatile product for an investor to start.
Yes,
start his journey.
absolutely. That's an accurate description.
Okay.
Absolutely,
Yeah,
I would agree with that.
So, do you do anything differently in your balance advantage fund compared to the multi-asset? Okay, I know multi-asset has got some part of gold, but does your strategy differ drastically over there, or it remains more or less the same?
No, I think the basic principles don't change. Of course, there are nuances because of the mandate itself. There are nuances that that make one framework a little bit different from the other framework. But the basic principles, underlying principles, the way we think about the different parameters that build the framework, I don't think we think very differently between BAF and multi-asset.
Okay. Since you have to look at more of the macro environment, in terms of, because that will have an impact on the equity market. Like you said that there is no company management you can go and meet and decide. It is more you have to take cues from the market and what is the geopolitical situation.
Sure.
So today when we are seeing this, we are elevated crude oil prices, right? So how are you looking at the environment today? Means what roadblocks do you see with this the high crude oil prices which we are seeing as of today?
No, absolutely. I think it's it's a very challenging environment, no doubt. I think historically, energy prices have always been, a very big determinant, I would say, of macro cycles. So every time we have seen a meaningful, sustained period of high energy prices, a lot of, it does have a big impact in terms of the global economic conditions. Many times it has even resulted in recessions kind of coming through. So it's a real risk. In that context, it's a real risk. Having said that, of course, today, as we are going through this phase of elevated crude prices, what most people and what most investors are trying to ascertain is, of course, what implications it has for the various macroeconomic parameters that you look at for a country, or whether external accounts, government finances, your inflation outcomes, your interest rates, all of that, that's currencies, all of that do get very meaningfully kind of, all these markets are very closely intertwined to these macroeconomic developments. But at the same time, from a market participant standpoint, people are also trying to ascertain whether it's a prolonged period of sustained high energy prices, or it's something which can be which we can see unwind in some months or some. It started off with a few days and it's now come to a few months. So that's where we are today. I think it's a very real risk, and most people are trying to work with certain assumptions. And I think today, as we stand, I don't think market is pricing in a sustained period of elevated oil prices. I think that
they are pricing in.
They are not pricing.
They're not pricing in. So I think that is also a risk.
That's clearly a risk.
Okay.
The market participants and in general the market behavior tells you that most people are still working with it being a few months of it being sustained.
Okay.
Because if these prices remain for long, then there's clearly, I think, a demand destruction scenario which will become more prominent. Today we are only working with not the demand destruction outcome. We are only working with elevated price outcomes.
Okay.
So that's where we are.
So that we if it gets more prolonged, then we can actually see some demand getting destructed.
Yes,
also.
in the past it has caused many recessions.
Right.
Energy crisis in general.
Because and as you said that everything is intertwined. I mean we are already seeing interest rates going up in US. The yields are going up. Inflation will also go up in India and then impacting businesses. So I think we can see that as an impact coming.
No, absolutely, absolutely.
So I think during these times, I think so multi-asset actually would get impacted quite badly, because if you see, if interest rates rise, it impacts the debt funds as a mark to market. Gold also is going to get impacted, and we are already seeing some impacts, so that gold prices are down. And as a corollary of all that, because the inflation is high, equity market goes down. So all these three factors actually could even impact a multi-asset fund.
No, absolutely. I think it's the general idea behind any product, like a multi-asset kind of a product, is about diversification. And if in the scenario that you laid out, if all three asset classes kind of react very similarly, then of course there is no benefit of diversification. These things do happen once in a while. These are of course Six Sigma events or whatever, very rare events where all asset classes kind of behave together in a similar manner. But it is possible. It's not out of the realm of possibility that these things happen. But I think the only thing is that, in a product's journey, it is less likely that in a diversified product you will see that outcome very regularly. Whereas in a single asset class, it is more likely that you will see it more often. Those kind of drawdowns happening through the journey. That's the only difference.
So here, many investors will have to control the emotions for quite a little time to ensure that they just go through that journey in that sense.
No, absolutely. I think in every asset class and in any product also, I mean, every product goes through their own cycle. While the journey in a diversified product is relatively more smoother, but uh, whenever you see outcomes which are disproportionate, for instance, in commodity prices, the outcomes that we have seen in the last 1.5, 2 years, I mean, they have been exceptionally great, exceptionally good. And you have to then start questioning on how long can you sustain such kind of very strong outcomes. And that is where I think the discipline of being contrarian, the discipline of evaluating in your frameworks whether the certain asset class continues to merit a certain weightage or it merits a sharp reduction in weightage. Those are questions which help us navigate through these phases because, I mean, otherwise, like you said, I mean, it is very possible that people do act in momentum. They chase assets which have better returns. That leads to outcomes which can be much more disastrous.
Okay. So, many experts are also talking about that, you should be prepared for uncertainty, right? Now, how do investors prepare for uncertainty? According to you, what should the investor be doing as of now? Okay, we are saying that we are in an uncertain world environment, right? We don't know what's going to happen tomorrow.
Right.
Completely getting determined by what will tweet at night, and we will wake up to something tomorrow morning.
Right.
So how does one prepare for these uncertain times? What, according to you, a few steps which they should take?
Even as investors, I think even as institutional investors, there is no one standard way of dealing with uncertainty, right? There are multiple ways. I mean, even if you look at portfolio managers working with the same product like a multi-asset, for instance, you might find different ways that people will deal with. Someone might choose to ignore increase his cash levels. Some portfolio manager might choose to be in more conservative asset classes, which he believes will be a hedge against an uncertain environment. Someone might choose to make his portfolios more defensive in terms of the choice of sectors or stocks or things like that. So the reaction to uncertainties, even across institutional fund managers, fund houses, is going to be very different. And because the nature of uncertainties themselves are very varied. So it's very difficult to kind of prepare against uncertainty because the reason why it's uncertainty is because it's uncertain. I mean, you don't know how it's going to hit you.
Correct.
So I think there is no standard way to deal with it, even as end investors. I think the best strategy in general is to remain committed to a certain discipline. I mean, and which is why I said that my initial point about a lot of investors today entering markets through financial advisors is a very good improvement over them doing it themselves. Because when they do it themselves, the chances of getting mistimed entries and exits is a bit higher.
Correct.
Whereas when you do it through financial advisor, it's more likely that he will guide you in the direction which will probably smoothen that. But if uncertainty has to hit you, it will hit you. So I mean, and once it hits you, what you do with it, how do you use that opportunity, all that matters a lot. I mean, you should.
Okay.
And that's where I think this guided way of dealing with it is something which can at least help you survive that post uncertainty period and make the most out of it. Okay. Because invariably things, when they go bad, I think that's generally the best time to kind of also create the next leg of wealth for yourself.
Okay. So, amongst all these things, and we realize that your job is more related with most of the things happening after you have gone to sleep. Because the US
Right.
markets are
Sure.
there, the geopolitical things keep on happening.
Yes.
So how do you unwind yourself?
No, I think, our work pressure is always there. I mean, whichever field you look at today, I don't think you can escape work pressure. I think whether it's obviously in fund performance, it's a daily performance that comes in front of you. Whereas in some other field, it might come a monthly interval or a yearly interval. But the pressure is, of course, there in every field. So I think for me, books and movies are two things which traditionally are resources for unwinding. And of course, since children have come into my life. Kids also have been a big source of unwind. So yeah, spending time with kids and doing some of these things
Okay.
keeps me sane.
Okay. So good. Good to hear that. So, we also do a rapid fire. So I would like to
Okay.
do a rapid fire with you.
Okay. I
So,
hope they are not very tricky questions.
no, so tougher skill, stock selection or asset allocation?
I would go with asset allocation, primarily because, like I said, too many macro variables and too
Correct.
many, uncontrollables, so to speak. In stock selection, at least you have the sense that you are in control of the situation a
Correct.
bit more.
Yes, I agree with you. One asset class investors misunderstand the most.
That's maybe in the Indian context, maybe real estate. I think
Okay.
it's an asset class which they
Right.
don't think as an asset class.
Right.
They get exposed to it, sometimes overexposed to it.
Correct. One market signal you pay attention to more than others.
So I think in our frameworks, we try to use the sentiment excesses as a meaningful filter. So yeah, sentiment excess might be something which we try and work with.
One lesson markets taught you the hard way.
So I think one thing is to take time to decide things, which I normally do. But once decision is taken, I think you need to act fast, particularly in today's rapid changing environment. I think I normally tend to be a little bit more gradual in my approach in changes. And that is something which is a work in progress for me as well, to start acting on decisions. Once a decision has been taken, it has to be acted on very fast.
Right.
Because markets, sometimes the gradual approach doesn't work there.
Correct. One word to describe the current investing environment.
Unsettling.
Okay. If investing styles were vehicles, what would a multi-asset strategy be?
Vehicles. Okay. Maybe an MPV.
MPV. One investing habit you wish more people followed consistently.
Judicious skepticism.
Okay. If markets would send investors one warning notification every morning, what would it say?
Maybe ask the question, do you really want to do this? So that might force you to think again, or maybe enter the trade tomorrow.
Okay.
When one day, generally a lot of trades which you do in haste are normally the FOMO kind of trades, which result in bad action.
Okay.
So maybe that one day, extra day that you sleep over and then come back to decide next day, I think it might be a good way to kind of avoid at least the hasty trades.
Okay. So thank you, Srini. Thank you for making it onto the Ventura Spotlight, and it was a real pleasure having you with us today.
Thank you. It was really nice catching up with you.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risk. Read all scheme related documents carefully